Hi, this is Eric, Chief Investment Officer and CEO of BKA Wealth Consulting here in Cedar Park, Texas. On April 1st of 2020, here to provide you another update of our thoughts and our assessments and our research into the market. And some of the data that we have has been leveraged off of our friends and partners up at First Trust, including Brian Westbury, and some notes that he put out here over the last couple of days. But as we're sitting here on the first day of the new month, the first day of the second quarter of the year, see our Dow Industrial Average is down about 26.6%, and our S&P 500 index is down about 23.5%. And what we do know, at least from a COVID-19 standpoint, is we've got 877,000 global cases. The U.S. caseload itself is about 200,000. We've got 4,000 deaths. White House last night in their daily press briefing had predicted kind of a dire outlook of 100,000 to 250,000 related deaths over the next 18 months. And it was driven off of a model. And so the kind of the somber message that was delivered with that was not taken well by the market today, which is down several percentage points. And the notation was made, and this is something that we've maintained all along based on everything else that we've read, that the case peak is likely about 2 to 3 weeks away. And just by comparison, if you look at the typical flu season, September to March, so far this year, 38 million Americans have had the flu, 390,000 have been hospitalized because of it, and then 23,000 people unfortunately died as a result of the seasonal flu. So again, the numbers taken in context don't approach what the flu, the annual flu bug has generated, but nevertheless, or numbers that we expect, the current numbers we expect to continue to increase. One, as more people are being tested, which we know is happening, and obviously more of the kind of at-risk folks that are contracting the virus or unfortunately succumbing to it. But, we continue to follow this data. And then obviously track and relate it back to the market and to the economy and the things that we need to do to help do our job in managing client assets. Just another reminder that this is not 2008. The market went down 40% after the banking legislation called TARP was enacted, and that the 2008 was a crisis of confidence. And really only when the accounting rules were changed did the market really begin to really positively react to that. And so, and I think now, as we look at the current situation, I think the market will, the economy was on sound footing heading into this issue. And then when we get, obviously we got pushed into a recession due to a wholesale shutdown of commerce. But as First Trust likes to call it, the magic bullet will be really when we can announce that we're open for business again as an economy. When that becomes kind of the new the re-normal, if you will, then I feel like the market's really people are gonna gravitate to the market, and the market, I think, will largely anticipate the recovery before it's evidenced in the data. Overseas, just kind of another anecdote on COVID-19, the data started to look a little bit better. We've seen some caseload kind of rolling over, and obviously we've seen it in China already, but we're beginning to see it in Italy. And new case volumes elsewhere in Europe are beginning to trend a little bit more favorably. And so the notion is that we're somewhere maybe 6 to 10 days behind Italy, and that as we get 2 weeks out, we'll begin to see that crest here in the U.S., and then case volumes will begin to go down as new people are being tested. So just a quick check back on what's been done today. I mean, obviously the Federal Reserve has stabilized the financial sector. This is not 2008. Financial institutions have access to capital and over $2 trillion of liquidity, which is monetary policy just from the Fed alone. There's been some rollback and some constraints on banks that would otherwise have to write down bad loans, and we know that there are going to be bad loans coming down the pike. So some of those restrictions have been kind of lifted a little bit, if you will, to provide a little bit of relief for the banks to, helping their balance sheets. Fiscal policy, obviously the federal legislation, the big news from last week, it will help to backstop small businesses, but we'll probably need more stimulus on top of this. I don't think that there's any doubt that there's going to have to be other things done. Now, just in terms of the market, this is the 16th bear market since World War II. The average peak to trough market activity has been about 30% in those 16 bear markets. And so far in 2020, in the span of just a very short window of time, we were down 34%. Which is above those averages, although 2008 was peak to trough was down 57%. I don't think we get there, but at the same time, I think we've kind of moved through all the panic selling, or at least most of it. We had a relief rally over 3 days last week, which ironically constituted the beginning of a new bull market. But I do think that there's definitely a possibility of us potentially having to retest our lows. And over the last 2 days, including today, the market sold off kind of violently once again. And again, I wouldn't be surprised if we retested the low that we saw over a week ago. But prior to the last 2 days, we'd had 17+% rally over a 5-day period, which actually includes Friday. But in any case, I think it's going to continue to be volatile. Stocks are pricing in what I would agree is kind of a 60-80% decline in corporate profits. Not sure that it's going to be that bad. I think that's probably a worst case scenario. And like I said before, the market should lead the economy, which I think by all accounts should grow in the second half of the year, as long as this doesn't extend too far beyond the next several weeks to reach the crest in the case volumes, and then they have the opportunity to get back to work and then reestablish some of the, at least from a manufacturing standpoint, supply chain reconstruction, and then from a service sector standpoint, rehiring workers, and in some cases having to retrain new workers. But it's going to take some time, and so you would still expect it to be volatile over the short term. But I would hope to believe, and I believe that we have seen kind of the lows, but we could be bouncing around here a little bit over the near term. Data, I don't think there's any doubt that we're going to see some bad data coming up, but at least kind of this look back data from March. ADP employment survey was down, but the survey was taken during the second week of last month, really before the shutdown. Manufacturing, we've already seen some of that data, and that's turned soft and shown some contraction. Unemployment, we got a weekly print of 3.3 million new claims for unemployment insurance, which is a historically high number. And we're probably going to continue to see more of those. Retail sales, we'll get that data, but ironically, with some of the stocking up and things like that, you might see some retail sale numbers be actually a little bit better than some people feel. Amazon's got some choke points in their distribution, but we know grocery stores are being sold out and things like that. So the data is going to be a little bit uneven there. Economic growth, we had such a really strong 2 months, January, February, and even beginning of March as the market rolled over. The data really hadn't gone negative yet. I think people we hadn't hit the shutdown yet. So with the weakness that we've seen in March, I mean, it's kind of a crapshoot what first quarter GDP is. I think the consensus is that we're already in recession, meaning that we're already in the first quarter of what's needed 2 consecutive quarters of negative economic growth. So I think it's fair to say that the economic growth for the first quarter could be slightly negative to slightly positive. We just don't know. And we won't know this, at least the first reading, for another 3 weeks. Second quarter, we know is going to be likely awful because we know we're starting out at a really, really weak position here in April. Uh, Estimates anywhere between negative 20 to 30% decline um, in economic growth, because we've got such a large part of the population that's not working, and a large part of the economy that's just literally shut off right now. So second quarter, fairly weak, but we won't know any of this for sure until the second or third week of July. Well, we'll get the interim updates, the manufacturing surveys, and we'll get the purchasing surveys and things like that, but we won't know the GDP number until we get into July. But again, this is not the Great Depression, which was a lingering systemic issue, and the fact that the backbone of the economy was fairly strong heading into this, I would feel that this is even though this is going to be the biggest net contraction in economic growth over one quarter that we've seen since the Great Depression, I think that this is probably going to be a little bit more shorter lived. And I think once we get back to work, we begin to repair the economy and some of the damage that's been done, that we have a very strong chance of having, anywhere between 4 to 5% growth, or 6% growth, in the second half of the year, kind of heading into 2021. This is shared by multiple people, and obviously, our friends at First Trust feel this way, and I think I would concur with that sentiment. That I think that we certainly have the opportunity for positive growth in the latter half of the year. Now, the other thing that I think is clear is that if we're going to contract 20 to 30% over basically one quarter, and then we're going to grow maybe, call it 5 to 6%, in the subsequent 2 quarters, it's clear that it's going to take some time for us to get back to where we were in terms of the total size of our economy. And frankly, it could take a year or two. My best guess, maybe 18 months to kind of get back to where we were, but still show positive economic growth, but from kind of that lowered base, if you will. Unemployment entering the recession, as all of you have heard us say. I mean, unemployment, the labor market was strong. Unemployment close to 3.5%. That represents about 5 million workers. I think over the near term, if you assume that 3.5% equals 5 million, and you assume that there's 12 million workers in the restaurant industry alone, let alone hotels and other sports venues and other entertainment industry related and hospitality related fields, that you could see a short-term spike, anywhere between 7 and 10%. So I just want to get that out there so that folks aren't necessarily shocked by that. We've gotten used to very low, very tight labor over the last several years, and to have this one, basically to shut down a large part of half of the economy, and have a spike up to 7 to 10% unemployment should not come as a surprise to most people. The other thing is, obviously the crimp on small businesses, and I think the federal legislation will work over the next several weeks to get relief to those folks in terms of some of the new SBA programs and austerity and the measures designed to get more relief to business owners. There's 30 million small businesses in the country. Without question, the longer the shutdown goes, the more of those folks go away, and those are jobs that are going to have to be recreated over time. First Trust, I will directly cite some data from Brian Westbury there. His team has put together an impact study that says if we're back by Easter, which I don't think is likely, 97% of the economy remains intact. If we're back in business, so to speak, by May 1st, their assessment is that 93 to 94% of the economy is intact. And if that date is June 1st, it's more like 85%, and July 1st, which is kind of again, I would say that's a worst case scenario. That number looks like 75% of the economy remains intact. So, so I guess it's clear in all of this rhetoric that the sooner we can get back to opening for business again, the better we're going to be, and the least amount of damage will be incurred on the economy, and the jobs that are lost because of that damage will have to be recreated. But that's clear that I think we're going to have more of a U-shaped recovery as opposed to a down and back up, a V-shape. And the violence of the near-term impact of shutting down this economy is just going to take time to repair. Just to recap some of these points, the turn we feel is probably going to be in what we see in the data is going to be over the next 3 weeks. And I think we'll have more positive things to talk about in terms of COVID-19 and its trends, et cetera, about 2.5, 3 weeks down the road. But the other thing that was brought up in some research that I read, which I actually think is worth monitoring. Now, we have not had inflation to speak of in years. In fact, having low interest rates and low inflation has been a very constructive environment for our economy. But with $2.2 trillion of stimulus, putting a lot of money into the hands of consumers who are going to use that money to consume. And at the same time that we've got a large part of our production economy curtailed, and so the supply of goods is going down. So if you've got more money chasing fewer goods, that tends to lead to inflation. So I think that's one thing that we need to watch is kind of over the interim period, what happens in terms of those extra dollars in the economy, stirring around, whether that ultimately leads to more more inflation. But in any case, I think I've covered all the points that I wanted to cover here today. But again, the market, the economic situation remains fairly fluid. I think again that we know that the data is going to be weak. I think that's already priced into the markets. We know that corporate earnings are going to be weak. I think that's priced into the markets. We're awaiting some of the pre-announcements. Most of the S&P 500 index companies that report on a calendar quarter, i.e., if their first quarter is January through March, they typically will start reporting their earnings about mid-April, again, in another couple of weeks, all the way through kind of the first week of May. So we're going to get a lot of reports, financial reports from those companies, but we're also going to hear from management and get kind of the more rhetorical commentary as far as what they're seeing real time in their operating environments. And I think that's going to echo everything else and reconfirm everything else that we already know, that it's really weak out there, that there's some known unknowns, that there's some risk factors that all of these companies and management teams are trying to fight through. But again, I think that once we see, as Brian Westbury likes to call it, that magic bullet of the data looking better, that will we'll have a better footing for equities to perform. And I think that as we see, some of the issues related to COVID-19 wear down, and more of the rhetoric in the press, turn back to the economy and the repair and reconstruction, if you will, of whatever has been lost, I think you'll find more enthusiasm finding its way into the equity markets. There certainly is a lot of liquidity out there that wants to maybe help support asset inflation or market-related growth down the road. It's just that there's a lot of, we're treading into this period of just, we still don't know. For all that we do know about the virus, there's still a lot that we don't know. And I think it's important that we keep our finger on the pulse, be steadfast, try to peel out the emotion, but also recognize that this is a marathon, not a sprint. That over the long term, we've seen these types of issues before. We've seen these types of market disruptions, and in every case, the market does come back. It's just going to take time, and it's going to take kind of that. It's going to take some catalyst, and so that's what we're monitoring here at BKA. We're working every day, with all of our channel partners and the people that we get research from, and just want to convey this information to you as we're socially isolating and working for you. And certainly welcome your comments, your questions, your feedback. You can reach us at our emails, www.bkawealth.com, and certainly appreciate your continued support. And please feel free to reach out to us if you have any questions whatsoever. Thanks, and hope you have a very good day and a very good week, and be vigilant and be safe.